What if you went to use your debit card one day and it just didn't work? You call your bank, you wait on hold, and then they tell you your account has been flagged, restricted, or worse, frozen. And here's the part nobody tells you. This is happening to people over 65 at a rate most Americans have no idea about. Not because of fraud, not because of anything they did wrong, but because of how banks are now trained to monitor older account holders. This video is going to break down exactly what's happening, why banks are doing it, what your legal rights actually are, and most importantly, the simple steps you can take right now to make sure it never happens to you or someone you love. Let's get into it. So first, why is this even a thing? Here's the context. Over the last decade, financial elder abuse has exploded. We're talking billions of dollars lost every year to scammers, fraudulent transfers, and family members taking advantage of older relatives. The numbers are staggering. The FBI estimates that elder financial fraud costs Americans over $3 billion annually, and that's just what gets reported. Now, here's why that matters to your bank account specifically. Because of those numbers, regulators, including the Financial Industry Regulatory Authority, known as FINRA, and the Consumer Financial Protection Bureau, have pushed banks to take action, and banks responded. They built internal systems, trained their staff, and created what are called suspicious activity protocols, specifically for senior account holders. On the surface, that sounds like a good thing, and it can be. But here's where it gets complicated. These systems are automated. They flag activity based on patterns. And some of those patterns, they look a lot like normal retirement behavior. Large withdrawals, irregular transaction schedules, transfers to family members, sudden changes in spending. To a 45-year-old, that might look like a vacation splurge. To a bank's algorithm scanning a 70-year-old's account, it can look like a red flag. And once a flag is raised, banks have the legal authority, in many states, to delay, restrict, or freeze transactions while they investigate, sometimes without notifying you immediately. That's the part most people don't know. In 2018, a rule went into effect that changed how financial institutions handle senior accounts. It's called FINRA Rule 4512, and it requires brokerage firms, and is increasingly being adopted by banks, to ask customers to designate what's called a trusted contact person. Now, this is where things get interesting. A trusted contact is someone your bank can reach out to if they believe you may be at risk. It could be a family member, a close friend, a financial advisor. The idea is that if your bank thinks something unusual is going on, they have someone to call. Sounds reasonable, right? But here's the catch. Most people don't think carefully about who they name. Some people leave the field blank, and some people name someone without realizing what that person could potentially do with that relationship, especially if family dynamics are complicated. Here's what the rule does not allow. A trusted contact cannot actually authorize transactions or make decisions about your money. They are a contact, not a cosigner. But the social pressure that can come from being contacted can be real. And if your trusted contact has bad intentions, they now know exactly what your bank is watching for. The takeaway? Choose your trusted contact carefully. Name someone you genuinely trust. And make sure they know what the role actually means and what it doesn't. Here's something banks won't say out loud, but it's built into how they operate. Many financial institutions now train staff to look for signs of what they call diminished capacity in older customers. That could mean confusion about account balances, repeating questions, seeming pressured by someone else on the phone, or making what staff perceive as unusual decisions. Now, here's why this matters. There is no standard definition of diminished capacity. It's largely a judgment call, and that means it's inconsistent. What one teller flags, another might not. What one branch manager considers normal aging behavior, another might treat as a concern. And once a concern is logged internally, it can stay on your account profile. It can influence how future transactions are processed. In some cases, it triggers a mandatory hold. Real-world example, there have been documented cases reported by AARP and major financial news outlets where older customers tried to withdraw money for a home renovation or to gift money to a grandchild and were delayed or denied because bank staff suspected coercion. Even when there was none, the customer had to prove they were acting freely. That's a frustrating position to be in, especially if you have a deadline, or if you're traveling, or if you simply just want access to your own money. The solution here is proactive communication. If you're planning a large withdrawal or an unusual transaction, call your bank first. Let them know, ask them to make a note on your account. That one step can prevent a flag from being raised in the first place. Here's a layer most people completely miss. Beyond federal guidance, individual states have been passing their own laws around senior financial protection, and some of them give banks even broader power to delay transactions than you might expect. As of 2024, over 40 states have passed some version of what's called the NASAA Model Act, the North American Securities Administrators Association framework. This framework lets financial institutions put a temporary hold on a transaction, typically 15 business days, if they reasonably believe the transaction is the result of financial exploitation. 15 business days. That's 3 full calendar weeks. Now here's what that means practically. If you're trying to move a large sum, maybe you're buying a property or transferring assets to a trust or helping a child with a down payment, your bank could legally hold that transaction for weeks while they review it. And in most cases, you won't know exactly what triggered the review. You'll just be told your transaction is under review. This is not a conspiracy. It's not your bank working against you. It's a compliance system that was designed with good intentions, but has real-world friction that most people never prepare for. What you can do: ask your bank directly what their senior transaction policy is. Get it in writing if you can. And for any significant transaction, give yourself extra time. Don't wait until the last minute. All right, here's what this all builds toward. There are 5 concrete things you can do right now to reduce your risk of unnecessary account restrictions. 1. Set a trusted contact intentionally. Don't leave it blank. Don't default to the first person that comes to mind. Think about who is genuinely trustworthy, financially literate, and emotionally level-headed, and talk to that person. Make sure they understand what the role means. 2. Notify your bank before major transactions, large withdrawals, big transfers, unusual activity. A quick phone call to your branch ahead of time creates a paper trail that shows you are acting voluntarily and with full understanding. It takes 5 minutes and can save weeks of hassle. 3. Review your account regularly and in person. Older accounts that show low engagement can be flagged differently than active ones. Staying engaged with your account, checking statements, making regular small transactions, keeps your profile looking consistent. 4. Understand your state's specific rules. Not all states are the same. Some have stronger hold periods. Some have more protections for the customer. A quick conversation with a local elder law attorney or a visit to your state's banking authority website can tell you exactly what applies to you. 5. Consider a financial power of attorney. This is different from a trusted contact. A financial power of attorney is a legal document that gives a designated person the authority to act on your behalf if you become incapacitated. It's not about giving up control now. It's about making sure the right person has legal standing if something unexpected happens. Without it, even your closest family members may struggle to access your accounts if you're incapacitated. So let's bring this all together. Banks are not the enemy here. Neither are the regulators behind these policies. The systems that can freeze or delay your account were built in response to a very real problem: older Americans losing billions of dollars every year to financial exploitation. But good intentions don't mean a frictionless experience. And if you don't understand how these systems work, you could find yourself caught in a process that feels frustrating, confusing, and invasive, even when you've done nothing wrong. The good news: this is entirely manageable. With a little preparation, the right conversations, and a clear understanding of your rights, you can stay ahead of it. Know who your trusted contact is. Communicate with your bank. Plan your major transactions with buffer time. And get the legal documents in place before you need them. That's how you protect access to your own money. Not by worrying about it, but by being informed. If this video helped you, share it with someone who needs to hear it. And if you have questions about any of the policies mentioned here, drop them in the comments. We read them all. Take care of your finances and take care of yourself.